Hi, a very good afternoon, everybody. Welcome to the March edition of Netra. So, every time I sit down to write this introduction, there's always something unfolding, whether in the markets, the economy, or on a global scale, keeping us all wondering what's next. Probably it's just human nature to seek a why behind everything, even when things seem normal. But lately, that sense of normalcy has started to crack. We've been talking about the unsettling calm in Netra, and now it finally feels like the calm has given way. The froth that had been building up for months is now starting to settle, but mind only in certain parts of the market. Meanwhile, the broader market is still searching for valuation comfort, though we seem to be heading in that direction. To further dwell on all of these and much more, I will hand it over to Sahil. Over to you, Sahil.
Thank you, Pragati, and good evening to all of you. This is the 46th edition of this report that we wrote and released on 5th of the month. And the idea has been to, sort of highlight all the relevant data points so that we can take an informed decision about, what's happening in and around us. And then probably the idea always is to possibly know where we are in the cycle, although we can't know and cannot predict the future. The idea is always to at least be aware at what extremities do we stand. So even in this report, in the month of March, what we've done is we've tried to resolve these data points in light of, let's say, the market action of the last few months. And we'll talk about this in this month's report. So I will deep dive into some important data points and we will discuss it. So let's first start with the full March edition. The first section of the report is thoughts on Indian equity valuations. And the large part of the report is only about Indian equity valuations, looking at it from various angles, and we'll try and talk about it. As Pragati said, if you have questions, please put them in the questions tab. We'll try to answer them at the end. So first, we'll look at the historical numbers on where do we stand right now in terms of, the price to earnings ratio, price to book ratio versus our own history. And when you look at these charts, you will find that the Nifty index, which is the large cap index, has more or less, reached the long-term average, the 20-year average for price to earnings ratio. And please note that these numbers are skewed. And this time when I put these numbers, they are not adjusted for the variation between standalone and consolidated. And there was a question yesterday on what is the impact of standalone and consolidated numbers. So prior to 2018, most of the data that you see for most financial companies was reported as standalone. And all the earnings, etc., whenever they were reported as standalone numbers. Very few companies reported consolidated numbers on their own. And then they were asked to report consolidated numbers. And after COVID, NSE also started to report the consolidated price to earnings ratio for Nifty. So from a standalone, it went to consol numbers. So whenever this transition happens from standalone to consol, the consolidated price to earnings ratio is always lower than the standalone number. So when you look at this number and when you look at the history, had we taken the full consolidated number, this average multiple would have been even lower. Right now it shows 20, but if you take a consolidated series, if you go back in some issues of Netra, we've shown a long-term consolidated price to earnings multiple also, which we have recalculated by going back in time. So when you look at that average, you will find that average will be close to 18 and a half times. It will be lower than the 20 average, which is visible on the screen right now. So that is one of the impact that when you move from standalone to console, the overall number will come down. So the average that we see today hides this fact. Okay, same is the case with price to book multiple. One very important crucial point which I wanted to show in this data is as follows. So I've made a line here and let me sort of magnify the price to earnings ratio. So we'll look at this chart standalone price to earnings ratio. You can see that when we had the previous bull market, which is the 2007-8 bull market, a price to earnings ratio of 25-26 time was the blowout top. It was an absolute kicker of a year where huge amount of returns were made, and then the markets declined. But you can see the price to earnings ratio, which is a standalone number, peaked close to 25-26 times. Even when the rebound happened, it peaked at 25 times, and then it declined to below 15 times in 2013 or so. And then the multiple kept expanding. You can see that there is an upward trajectory in the multiple until after post-COVID, where it peaked because the earnings were absent completely. And this is the period, a 10-year period, which has sort of made the averages go haywire, right? You can see this period. So if you remove these anomalies, you will find that the average multiples for India are much lower than what they seem visible. So when you see in public discourse, people say that we are now below 5-year average or below 10-year average, which is what I have written here, right? Which is below 20 now, which is the long-term average. You have to take it with a pinch of salt because the average itself is trending upwards for two reasons. One, Indian equities went through a re-rating. Second, this is a standalone number, which is now being compared to a console number, right? So if you adjust for these two factors, only adjusting for standalone to console, minus 200 basis points. So 20 average should be 18. If you remove the re-rating component, which I don't know why we should remove, or you can argue against it, right? You can say that India is permanently re-rated, but nothing is permanent in life. But let's assume that it is true. Then you will still be at 18 average. But if it is not permanent and if it is temporary and we can go through a de-rating phase, which we did, you can see after 2008, we had a de-rating cycle, right? So if that is the case, then even 18 average is high, right? So if you remove that number, then you will have to remove another 100, basis points to reach a more normalized number, which is maybe close to 16 or 17, right? My guess is that it is close to 17 times, but of course it is a guess, right? So this is a very important differentiation that you should know when you look at average multiples from the market, and don't be guided by them very blindly. They are just some yardsticks that you have to use logically. And we'll talk about in the next few slides what is actually the PE multiple that we should give, right? This is the average, historical average. And there is a saying that you should never cross a river which is 4 feet deep on average, even if you are 6 feet uh, tall, right? Because averages belie, right? They hide a number of things. So we will see what is the number that ideally should happen given where we are right now in terms of numbers. We'll come to that. Second important point, our market cap to GDP ratio is now 116. You can see there was a big upward trend along with the market. Our long-term average is 71. You can see that this long-term average was much lower prior to 2005. Again, averages belie those numbers. So maybe somewhere close to, you could say 71 to 75 or maybe 80% is where our long-term average lies. But we are still far away from that number. Another important fact is that we were at a very high premium to other emerging markets. That has sort of come down. Why? Because in some other markets like China, there is some amount of earnings which have made a comeback. Their valuations have started to improve. There has been an equity rally. In India, because of the recent correction or fall in prices, our valuations are now at a long-term average versus emerging market, right? So emerging market as a peer group is not a very logical number to take, but in any case, even if we follow the passive flows, maybe this is a number that passive money looks at. So that froth is also sort of going away. So in a nutshell, on this slide, you will see that some froth has been washed off. A part of it, maybe a large part has been washed off, at least from the large cap space. As you can see, is the case with Nifty. But we are still not average multiples, right? We are not at the long-term average. Maybe we'll reach there, and we'll see in the following slides what are our thoughts on that. So the second slide is particularly for small and mid cap universe, and this is the median trailing 12-month PE ratio for small and mid cap stocks. So you can see that I have made this chart earlier also, showed it many times. And you can see in 2007, the median multiple was 20 times. 2017, a big bull market, it went to 29 times. In this bull market, it went to 46 times, right? Now you could argue that this mean is going up. Some could argue that it will go to X number. I don't know what number, but you will see that in most small and mid cap bear market, this number comes back to averages. In this bear market, it completely crashed, right? You can see the median number went to 5, which was a completely crushing blow for small companies. And then it stayed between 10 to 15 for a number of years, right? And then we had another bull market, it went to 29, went back to 15 times. In fact, when we had this small correction in 22, in 23 March, which is where the rally started, the multiple at that time was at 28 times, right? This is the median multiple, okay? But if you go back to 2023, at the bottom, small cap and mid cap stocks index, both indices were trading at 21 times multiple, right? Currently, they trade at about 28 and 30 times multiple, give or take. They were at 21 times at that time, right? So, but the median multiple was 26. Once again, right now we are at 33. So there is some distance to be reached. Now, I have no idea whether we'll go to average or we'll settle at 23 lows. I have no clue. But if you go back to history and see, let's say 4 or 5 year bull market, which was this bull market, and then again a 3 to 4 year bull market, which was this bull market. And when you see that we enter a bear market, mostly we go back to averages. Now, do we go back to 19 times, 20 times? Anybody's guess. But the moot point is that within the small and mid cap space, there is still a distance to be covered in terms of valuations to become attractive. They are not yet attractive. In fact, they are not even average right now. They have just come off from very expensive levels to maybe you could say expensive levels. But if you were not at 46 peak, 33 would have also looked very expensive, right? So they are still less expensive than the extreme number, but the extremity was so high, it's so out of whack that even the correction has caused them uh, to still be above the 2017 multiple, right? So it's not very easy to take these calls based on these numbers, but one thing is clear that there is still some distance for this space to reach multiples. We also present to you the time lapse or slightly longer term view on numbers, and you can see that when we made this chart for the first time, I think about 8 months ago, what we wrote was that when you look at the small and mid cap space, which is the lower panel, I've written it here that only 1 in 3 stocks, right? I've written it here that less than 1 in 4 stocks actually was trading below 3 times price to book. This was about September, right? 8 months ago or so. And now this number is 1 in 3. So from 25%, we have made progress. Another 8% stocks have started to trade below 3 times multiple. But when you take a look at the history, roughly we've seen that this space becomes attractive then when at least half of the universe trades below 3 times price to book, right? We can go in deep explanation by why is that the case, because all these numbers are linked to how much profitability the companies produce, whether it is the return on equity or earnings growth. You will be able to find the linkage mathematically. Those linkages are not absolute. That means because stock prices are not absolute, they are dictated by human emotions. So they will not be absolute answers, but you will get into the vicinity of this number, which means that nearly half or more of the universe, if it trades below 3 times price to book, that means you are in good territory where you can allocate and not take any valuation decision at that point in time. That number itself is enough. Right now, for small and mid cap, we have not reached that level, right? The next is a broader market valuation summary. You can see the red bars here. You can see 2 bars, black and red. The red bar is the market peak, which is September 24. Now, in hindsight, we know that was a market peak. So we've taken the price to earnings multiple for all companies in BSE All Cap Index, which is roughly about 1200 or so companies. And you can see that there was almost 500 companies or so which had PE of 50 or more, negative P included. In fact, half of the universe had a PE of 40 or more. You can see this number, right? Half the universe had a price to earnings multiple of more than 40, right? And now we have seen a downshift. You can see that the numbers have reduced significantly, which means that the 40 number has gone to 30. So the average multiple has declined, market has derated, a lot of stocks have derated, and which is a good thing. And this is a healthy sign that for long-term investors, you are now getting more stocks which are cheaply priced versus what they were earlier, right? You can see that initial number, which was close to 210, 215, has quickly jumped to more than 320, right? 350. So you have a lot more companies below 20 times multiple now than you had earlier. So which is a good thing for stock pickers. This doesn't give you full confidence that you will be able to pick stocks, but yes, it gives you an understanding that there are more companies where valuations will start making sense. So that's why there is a downshift that we are witnessing in valuation. Again, a good outcome from a longer term perspective. Now, the point is that, what all does it mean in terms of valuations, right? In terms of earnings growth. So these are two very, very important charts. And we have made some variations of these charts in the past and many other similar charts. But I think they tell the story very, very well. So if you look at the upper panel, it shows you the BSC 500 sales growth, which is the top line growth, which is the blue line, and the BSC 500 PAT margin, right? So you can see these two numbers, PAT margins are very high, close to their all-time highs, and the sales growth has already declined, right? And I have explained it in a number of these webinars that when you look at earnings growth, there are three drivers. One, higher sales, that means you start selling more. Second, margin expansion. Third is efficiency. So right now we'll not talk about efficiency. We'll talk about it in future. Right now, it is not visible so much. But when you look at the top line has decelerated, right? We were growing close to 15-20% earlier. Now we are growing in single digits, right? Similarly, PAT margins, which are at all-time high, they have started to come down, right? If you go back to the Feb edition, we have shown how non-financial PAT margins have started to decline, right? So these numbers, and you can see all the commentary around corporate results. You will note that many companies are now reporting lower PAT margins. So think about this. If a company is beginning to see sales deceleration, which means that if you are selling 100 units and growing at 20% per year. So in year one, you sell 100 rupees worth of product, then you sell 120 rupees worth of product, then you sell 144 rupees worth of product. But then in the next year, the sales growth, rather than being 20%, becomes 10%, right? So you go to 158. So your sales number slows down. It is still growing, but it grows at a smaller pace, and your margin also falls, right? Which means that the per product margin, for example, let's say if it was 10%, has, let's say, come down to 8%. So incrementally, the profit growth will also slow down, right? And this is what is now happening. And we have been talking about it for last, I think, 4 to 5 quarters, that this is now becoming visible in numbers that top line has slowed, which was already visible. So you can see that now. And margins will probably peak, and they peaked about 1 or 2 quarters ago, and they've started to come down. And this is the result that PAT growth, which is the lower panel for large cap and small cap, both has come down. Now, for mid and small cap, the expectation was that PAT growth will continue at an accelerated pace. Okay. So now you have to be very careful in listening to what I'm saying now. Market was trading at high price to earnings multiple because companies were able to deliver strong earnings growth. And because of strong earnings growth, the market was maintaining a high price to earnings multiple, right? And then now in the last 2 quarters, what we've seen is that earnings growth itself has come down, right? There were already signs from sales growth and margins. It took some time, right, to turn. And now market participants realize that for a company for which I'm paying a 30 or 40 or 50 times multiple, if the earnings are not going to grow at 25-30%, then what is the multiple that I should pay? That multiple is much lower, right? And that is the D rating which is happening in the market right now. And I have written about it, how to calculate it at an aggregate level, and what should be our thought process in thinking about what should be the multiple. But one key takeaway from this slide is that because of the slowness in earnings growth, maintaining high earnings multiple is going to be a challenge. And that is what the market is going through, that process of reducing that price to earning multiple because of the profit growth. Now, there could be a question, can this profit growth go back to 20%, right? If that is the case, then multiple will again re-rate upwards. But all the drivers of high profitability, which is higher sales growth, are we seeing signs that we can do 20% sales growth? I don't think so. Nominal GDP is under 10%. Core inflation is 3.5%. Export growth is very, very slow. Services export growth is closer to low, high single digit, right? So we are not seeing any signs where 20% profit growth will come from. Margins are on the decline. So therefore, to expect companies to have 30, 40 times price to earnings multiple while they report 10 to 12% earnings growth is going to be a bit challenging, right? So this is how we define, and this I think is one of the most important slides, probably one of the most important slides we've written in past 6 months or so, and it explains to you what is the rationale behind what is happening right now, right? So we will look at two indices. One is Nifty 500 and Nifty 50 index. So let's look at Nifty 50 because that is more commonly known. In September 24, when it peaked, now we know in the hindsight, it was at 26,200 or so. Now it is down by 4,000 points or so. And the change is 15% decline. P ratio, which was 24.8, is now close to 20, nearly a 20% decline. ROEs remain more or less steady. Earnings growth, which was 15% then, is now 11%, right? This is EPS growth. If you look at PAT, aggregate PAT growth, the number is much slower at about 7% or so, right? Similarly, for NSE 500, index correction 18, P derating of 20%, RO is more or less similar. But again, you see earnings growth, which was 22%, has come down to 14.5%, a deceleration. Now, the question is that if earnings are going to grow at, and my guess is this number of 14 and a half for NSE 500 may go to 10 to 12%. And for Nifty, again, between 10 to 12% or even lower, right? So if this number is going to be 10 to 12% and RO is going to be 15, what is the multiple that market should trade at? So mathematically, I've written it here that if the index trades between 17 to 17 and a half times, then it appears more logical that we have hit some sort of an average zone where it takes care of market valuations, which means that we will exit the frothy zone and enter what I call an average zone. And we are more or less very close to there in the large cap universe. Now, why am I saying that? Because Nifty did get close to 22,000, give or take 100 points. And if you do simple mathematics, this year Nifty EPS will likely go to 1150 rupees, right? So when it touches 1150, I don't know which month it will be, whether it is June or September or December. I have no clue, but we are anyways close to all these months, right? And if you take a 17 and a half times multiple, then between 19,500 to 20,200 index levels, you will reach that comfort zone where the valuations will go to average, not only on historical basis, which I explained in the first slide, but also based on the current return on equity and earnings growth, right? So you will hit sort of a pocket where valuations will cease to make a lot of difference. And therefore, I think that within this range, from today to this range, it is more logical to dilute our conservative stance, which sort of we have held for a while, and be more moderate, which means that you continue with your large cap equity allocations, whether it is a staggered form or adding an accelerated STP in large caps. I think it makes sense. If you get to these numbers, then making lump sum investment will also make a lot of sense in large caps. Now the question is, uh, when will they become cheap, right? So when stocks become cheap, do they present very high chances of extraordinary returns, right? So maybe I'll go back to the first slide and use it to show you what do I mean by cheapness and how to capture it. So for example, if multiples are average, they continue to be at average. But if you note that multiples become very low during crisis period. So during COVID, they crashed to 15 times. This doesn't show clearly, but consol multiples were close to 15 or lower. Twin balance sheet problem, European debt crisis, all this is in hindsight, right? Global financial crisis, multiples crack significantly. But the question is, can we predict these crises? The answer is no. We have no way, no clue when any of these crises will occur. We can make a guesstimate that this is XYZ happening. It could lead to a crisis, but markets have a much stronger memory than what we have and a much stronger anticipatory mechanism that we have. So there is no way that we can predict whether valuations will fall from average to cheap or not. We don't know that, right? So when it touches average, you go back to your moderate equity allocations. And I think that is what we are trying to do. that if equity allocations go to averages, then possibly we'll go back to average equity allocation. And another question could be, when do we become aggressive? We become aggressive when we get cheap equity prices. Now the question is, will we get them? The answer is we don't know. There is no way to estimate or know, and therefore to keep that extra buffer all the time is what separates great investing outcomes from average investing outcomes, right? So, and I think that will be the crucial lesson in this cycle as well. Whether we hit a cheap pocket or not, I have no clue. But is it possible? It is entirely possible, right? The next three slides will talk about where the aberration still persists. So, for example, look at the small cap universe, right? And I wanted to highlight this number because it is very important. It will help you take a clue on where we currently stand in the cycle, right? So this is the small cap universe. We've taken small cap AUM of all active funds. So this is not only small cap active fund universe, but all funds which invest in small cap, whether it is a flexi cap or any fund investing, taking any exposure in the small cap universe, which is stock number 251 to 500, we have taken that AUM of only of the small cap universe, right? And we've taken 12-month rolling net flows as a percentage of free float of small caps, right? So just to give you a clue, what does this mean? So the overall, when you look at the free float market capitalization, you will see that about 50-55% is a free float market capitalization. Between 50 to 45% is held by promoters. So when you look at the free float, out of that free float, roughly about 20% is held by clients, right? And I'm talking only about small cap universe right now, and 20% is held by mutual funds. Number is 19 point something, but 2020 roughly is the number. So 40% of free float is held by either direct clients or by mutual fund AUM, right? Out of the overall 100, right? In the last 12 months, you will see that 8.2% of this free float came through active equity funds, which is a very large number. 8.2 of the overall 100 rupees of the free float, right? Which I calculated as, about 50% of 100, right? So 8.2% of that number came from active small cap funds. And I have, historically also spoken about this that, flows chase returns, they don't cause them, right? And this is a clear data point which tells you the same thing. Now, the point is, will these flows be sticky? And this is again a new metric which is going around in the market, that a lot of flows will stick around, whether it is SIP money or small cap flows. But this is not how history runs. Historically, what we've seen is that when money chases stocks at high valuations, invariably a large part of those flows go out without making a lot of returns. So our estimation is that either these flows dry up within the small cap space and they even out over a period of time through consolidation, or you will see an accelerated outflow, right? Now, these words are equivalent to saying that a small and mid cap space bottom or cheapness in valuation can occur with a capitulation, where a lot of people sell what they bought because they bought at high valuation, their expectations were not met, and that is how equity markets bottom out, right? There are no equity bottom which are slow. They are mostly very, very sharp. And I don't think that we've seen that sharpness as of now. And possibly these kind of flows, when they even out over time, either they even out over time or they go out at an accelerated pace, that is unknown. History shows that mostly it happens in an accelerated manner. And I think that will probably cause the earlier numbers, which I showed you, these numbers, where half of the universe goes below 3 times price to book, or this number goes back to average, right? That all these numbers will realign at the same time. As of now, we have not reached there, right? But for the large cap universe, more or less, we've seen that we are getting close to that number. But another slide, which is very, very important, and I wrote about it some days ago also, that this time in this correction, Nifty has fallen about 15% or so, give or take. VIX has not gone up, right? VIX is a measure of option pricing, or people's way of expressing how volatile the market will be or how volatile the index will be through option pricing, right? And it is a market pricing mechanism. It is not a theoretical exercise. So it holds a lot of value. Now, VIX has not gone up because Nifty has not fallen in an accelerated manner. We haven't seen even a single day where Nifty fell 5%, which is very unlike the past corrections, which are usually very sharp. So just to give you some parallels, COVID correction, I think some of you will already remember we had one or two instances of index falling 10%, 8%, 7%. In 2008 decline, there were multiple instances. For example, between 8th January to 31st January, the index was already down 25% from the peak, right? So these numbers are very sharp and they cause huge uncertainty and people are ready to pay very high price for options. So premium goes up significantly. We haven't seen that happen until now. What does this mean? Can it happen? Maybe, right? It can happen that you also see a selling pressure in large caps where the index falls and this VIX goes up. So it becomes a more comfortable sign, right? But is it necessary? No, because of course, there are many cycles which are different from the past, and maybe we are in a different cycle. But if you see there is a capitulation event where VIX rises significantly, it gives you a good contrarian sign that yes, there is a lot of risk off in the market. A lot of people are more fearful, and I think that will be a much more robust sign that we could raise our equity exposure to a much higher level. We haven't reached that sign yet. But in large caps, I think, as I said earlier, valuations seem much more attractive, not attractive, less expensive or closer to average versus what is appearing in small and mid cap space. The next again is the market breadth. And I wanted to highlight one indicator here, which is the number of new lows which is happening in the NSE 500 index. So number of companies making new 52-week low. Every time you'll see a large market decline, you will see that this number goes to about 200, and that is a single day reading, right? Which means a lot of companies are making a new 52-week low. In this correction, in spite of slightly sharper cut in mid and small cap space, which is part of NSE 500, we haven't seen that number occur. So which means that the number of companies making a new 52-week low haven't it hasn't really touched that number of 200, which is what happens in most cycles, right? And usually after a 4-year, 5-year bull market, these numbers go much higher. When the market declines, these numbers are even higher. I think if you calculate historical average, it will be closer to 225 or so, which is right now at 155. And this is, of course, a one-day event. Again, tells you how to see, let's say, a capitulation type of an event, appearing in front of your eyes whenever it happens. So these are all the data points which will come in handy if it occurs, right? It may not occur. We have no clue whether it will happen or not. But when it occurs, it will give you an indication that the time has come to raise equity weights or be slightly more aggressive about it. Those numbers have still not appeared on the screen. Uh, what is a good outcome in this cycle, which will set the tone and base for the market? One is that this is a good cycle in which corporate balance sheets have not been compromised. So in this cycle, companies, in spite of doing very well, did not take too much debt. In fact, they have repaid debt. So you can see that over the last 5 years, corporate net debt has gone up by only 1% CAGR, although our long-term average is about 17% CAGR. So balance sheets are very, very strong, very clean, right? And this gives you a very good comforting factor for the next cycle. Whenever it occurs, it will maybe start up with companies which are sitting on good, strong balance sheets. For example, a sector which comes to mind is the spick and span balance sheets of metal companies, right? And also, when you look at the median total debt to asset ratio, it is at 19%, which means that lot of debt has not been used to create new assets, which is again a good outcome in this cycle. And this number has decelerated. Prior to COVID, it was flattish and high. It was very high when we had balance sheet crisis. Almost one third of assets were being created using debt. Now this number is at 19%, which I think is a very low number, which shows you that balance sheets are much stronger than all the earlier cycles, which I think is a good comforting factor when you think about valuations. And I think we'll come to these numbers when we see valuation froth completely out of the market, some of these numbers will be very helpful in identifying which company and sector is what we should bet into. But we should be aware of these numbers now. When the correction is already in force, we should be prepared for them. The next is the lot of efforts that RBI is making in infusing liquidity. They haven't succeeded yet in removing the interbank liquidity deficit, but we think that these actions are useful. Eventually, they will work. We've seen that historically, RBI is the authority which takes care of the short end of the bond market. Maybe not the long end of the bond market, but of course it can control the short end of the bond market. They have all the tools and ways and means to do it, and possibly they will be able to control it. Structurally, January, Feb, and March usually sees a lot of liquidity issues. They are more seasonal in nature, and this time we have mix of two things happening together, which is what is making it more tougher to navigate this environment. But we think that these measures are useful and possibly will set the tone for liquidity enhancement or balancing out as we go ahead in the future. A lot of OMO announcements, which I think is the real deal. VRR auctions possibly are sort of a band-aid, but OMOs will probably help this to end this liquidity crunch. You can see that liquidity deficit is still persistent in the banking system, but I think by the time we reach April, mid-April or end April, possibly we'll get to tackle this situation. Will this automatically result in higher equity prices? I don't think so. But it will, of course, be a more beneficial scenario for overall market backdrop and, of course, for lending and borrowing purposes. So what should investors do? We think that it is the time to shift from a conservative to a more moderate stance, specifically in the large cap space. And the time for aggression will come, but it hasn't come yet, as I explained in all the numbers. B, you should raise your equity exposure by one notch. How to do that? By using hybrid funds. So a lot of hybrid funds like a BAF or DAF category or multi-asset allocation strategy will automatically increase their equity exposure because valuations have come down. And wherever they come down in any stocks, because they are actively managed, they will try and allocate more to those sectors, specific stocks, etc. So it automatically raises your equity weight. So I think this is one of the best ways to do it. Another method is to top up your SIPs, specifically in large cap space. I think this is a good time if you want to increase your SIP amount. It's a good time to do that. Again, focus on large cap for staggered purchases and equity allocation. BFSI, specifically private banks, I think it has hit a good, strong bucket or band where valuations are necessarily attractive, not only average but attractive, right? Maybe out of the all the sectors, if you could pinpoint one sector where valuations are actually attractive, it is the private banking space, and that space is still exposed to the vagaries of the market, which means that if market declines 10-15%, of course, this space will also take a hit. But its ability to make a comeback will be much more stronger. So I think this is a place where you should be looking for actively considering addition. And C, do not become very aggressive right now in small and mid cap. I think the time will come. If at all, you can use a STP or a SIP route in that space because we can still detect some amount of froth. The second section is mixing of assets, and we made this point earlier also that it is not any standalone asset. All standalone assets, whether it is global stocks, whether it is gold or Nifty, they are much more volatile on their own. But when you mix them up, the volatility goes down. As you can see, the combined portfolio, which is the blue line, is much more smoother than either of these assets. So therefore, it makes a decent case for all long-term investors who become perturbed by volatility to look at multi-asset allocation or even hybrid space more closely than a pure equity space. And we've been talking about this in bull market. We'll talk about this in bear market also. In all markets, I think it is much better to mix assets and have a portfolio which is more diversified. Second is gold. Over the last 2 years, we've had a positive view on gold. It has played out somewhat. We've also published data where we've shown that gold has outperformed all emerging market equities except India, almost all developed market in the last 25 years or so, and which sends out a signal that gold always outperforms. That is not the case. And we wanted to show here that even gold is cyclical, right? All security prices, whether it is gold or stocks or bonds or any other asset, you will find that there is cyclicality, which means that there will be periods when they will not perform. And this is the 10-year rolling return for gold. You can see for a very long period, almost 15 years, gold practically did nothing, right? And then when it bottomed out in 99, and it rallied till 2011, where it 10-year CAGR became very, very high, right? Now we are sort of middling that number now. Just 2 years ago, this number was very low, where we started saying that gold is a very attractive asset, but I think it is still has a long way to go. So most possibly the bull market continues for gold, but please do remember that it is one of the assets, and mixing of assets is very important. No asset is secular in nature. All assets are cyclical, including gold. Uh, Gold miners, we've spoken about this earlier, and we were expecting that the higher prices for gold will show up in the profit and loss statement of gold miners, and now we are able to see those numbers, right? They have started reflecting in higher sales, higher EBITDA, higher gross margins, higher EBITDA margins, which is a healthy sign for miners. And another healthy sign is that they continue to remain cheap. So we believe that this is a sector which you should continue to hold. It's a very volatile space, but we think that the likelihood that it does better from here also is much stronger. Next is silver, which hasn't done as well. We anticipated it to do much better than gold, but over the last 3 to 6 months, it hasn't really moved. It has been between $29 to $32. One odd week, it went to 35 or so, but it hasn't moved. But when you look at the drivers for the price, whether it is the demand supply, where it is in deficit, supply is in deficit, whether it is a gold silver ratio, or whether it is a short term supply chain issues, everything tells us that there is a structural shift in silver demand supply matrix, and good likelihood that it does well from where it is. So it should be in the mix. It's a much more volatile asset than gold. So it has to have lower allocation than gold, but I think it should be in the mix. We could see a larger up move play out in silver, and we'll continue to watch how it moves ahead. The last slide is that if you want great investing outcomes, there is a combination that we need to have low valuations. That means what we are buying should be cheap. We should have investable capital, which means that we should have money when there is low valuations. If you are always fully invested, then the only thing that you can do is cut down bad stocks and buy good stocks, or cut down overpriced securities and buy cheap securities, which is a rebalance. But third, the most important ingredient is courage. And courage comes only if you have investable capital or cash at low valuations, which is a very rare combination. And if this combination is available, it can allow you to create market beating returns. One circle which is missing is the quality of companies that you buy. I think that goes without saying. If you compromise on that, nothing will work. So with this, I will stop here. I think we have taken care of all the slides and spoken about the concepts.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.